Hello and welcome to Quantbeats, where we dive deep into the world of quantitative finance in a video series co-hosted by myself, Dan Hubscher, and Radovan Vojtko. Rado, please say hello.
Hello, hello.
Rado is a former portfolio manager at Tatra Asset Management, where he managed over 300 million euros in several quantitative funds focused on asset allocation, multi-asset, CTA, and trend-following strategies, market timing, and volatility trading. And since 2015, he is the CEO and head of research at Quantpedia. I'm Dan Hubscher, managing director and founder of Changing Market Strategies, helping market participants discover new innovations and gain collaborative insights about new technologies into quant, crypto, blockchain, AI, and alternative data. With over 20 years working for electronic, algo, and quant trading firms and fintechs, quant and crypto funds, and investors, I'm your resource for all things quant. Today, we're joined by our guest, Alex Gillula, manager of Tocaya Capital Management, to get his insights into the world of quant. Alex, we'll get to your background in a minute, but for now, just please say hello.
Hi, everyone.
Thanks. So for more on Rado's background and my background, you can check out episode 1 on the Quantbeats YouTube channel. Now, before we get into today's discussion, as I'm a registered representative, I need to show you some quick disclosures that are on the screen now, and you can contact me with any questions. We'll be giving you ways to contact me at the end of the episode. Okay, now welcome back to the Quantbeats video series, where Rado interviews some of the most brilliant minds in quantitative hedge fund management. We'll strive to bring you unique opportunities to gain invaluable insights directly from industry leaders, enhancing your understanding of complex quantitative strategies, market dynamics, and the future of algorithmic trading. Whether you're a seasoned investor, an aspiring quant, or just fascinated by the financial markets, this series is your gateway to the cutting-edge world of quantitative finance. So, to kick us off, Alex, why don't you introduce yourself? And then Rado will take it from there. Alex, go ahead.
Thanks, Dan. Hi, everyone. I'm Alex Gillula. I'm the founder of Tocaya Capital Management.
Thank you, Alex. Now, I will probably start with the first question directly. So, what is the journey? Why you became the quant? My mother wanted from me to be the dentist. but I mean, I like the history. I like the mathematics, etc. I mean, I could be the dentist who is the history lover, but I'm the quant at the moment, and I'm the quant researcher. So, I mean, what is like your background?
I would say it actually comes down to kind of two key moments in my development when I was a younger man. In my teenage years. The first happened about the time I graduated high school. I became interested in the mind and consciousness and how humans became conscious and started asking questions like, are other animals conscious? How does it work? And that kind of unlocked the whole study of complex systems and complexity theory for me, and starting to read and understand things about how do systems come to this behavior of this emergent property where the sum is greater than the parts. And ultimately, if we think about the stock market, that is definitely a complex system, and there's a lot of participants coming together and creating an environment or an ecosystem where the sum is greater than the parts of each individual trader. That was the first key moment that kind of led me on that path. The second was kind of funny. I had an internship when I was in college, and I was studying engineering, and out of your freshman year in college, you can't really get any good internship. So I came back home for the summer, and I landed a job at a construction consulting firm that did construction site inspection. So this whole summer, I was lugging around this equipment that would test soil compaction and also test concrete stiffness, essentially. But so there's a lot of downtime because they're not always pounding the soil and they're not always pouring concrete. And in my downtime, I was, just reading, and I had a magazine. I think it was called Popular Science. And it had an article about some NASA scientists that had recently redesigned an antenna that was being used in space to relay information back to Earth. And they optimized this antenna using a machine learning algorithm. It was called a genetic algorithm, which is a machine learning approach that's kind of fallen out of favor now with all the network-based machine learning that's in vogue right now. But that got me thinking, like, that's really cool. You can have machines optimize things. And I had a brokerage account at the time with a couple $1,000s, and I thought, man, wouldn't that be cool if you could actually use math to make investment decisions? And that was the key moment for me that kind of led me on the path to where I am now.
I like it a lot. I mean, especially the concrete thing. That's a great. So I mean, that was like the first part of the journey, and then I mean, there is always a lot of the steps. I mean, to have the own fund. So how I mean, it developed over the years.
Kind of in my early 20s, I had this goal of mine that I wanted to use these ideas to create some kind of investment strategy. And so all of my work during college was kind of focused on that, and the courses that I took and what I studied, I always kind of had that in mind. After I graduated and started working in finance, I was kind of working on that goal in the background the whole time. So I was working for a company doing essentially, we were doing kind of consulting for trading desks, consulting for the buy side, providing them a signal library and online web-based tools that they could use to optimize portfolios. And then on the trading desk, we were providing analytics to understand how traders were impacting the market using different algos. It was useful for me, although I wasn't at a buy-side shop. I had this unique perspective that you might not get if you're just working at one shop. I saw different approaches from different firms, how they did things, led to some of the key insights early on that helped me build my ideas to develop my strategies initially. And then, after 5 or 6 years, I got to a point in my personal situation where I thought it was a good time to take the leap, and then ended up starting Tocaya Capital from there.
I know that you are using the machine learning, so in your case, it's mainly about having the good data. Because I mean, the machine learning is like what you put inside, you will get outside. So, but still, I mean, in a machine learning, you need to have some insight. I mean, how to build a machine learning model. I mean, what are like actually important parts for the machine learning? What is the source and inspiration? So that's an interesting part for me.
The source of the strategy kind of before, or the source for ideas about how to like actually create the machine learning.
I would say the strategies itself. You were interested in stock market, in trading, etc., because you were looking at it from the perspective of cognitive science. So I would guess that some of the ideas that you have are related to this kind of the top-down approach. How do you come up with ideas for the trading strategies?
Sure. So I mentioned this idea of complexity theory and complex systems, and that's important for me because what we do with our approach is inefficiencies that exist in the market are due to investor biases, investor or institutional biases that exist within the system. So the mantra I have and kind of my investment philosophy is that news doesn't move stock prices. News influences investors, and investors move stock prices. And it's a subtle difference, but for me, coming from a background of transaction cost analysis and seeing all the flow on the trading desks, it's important because there's a human behavior and a human element to the investment process. We focus on events and news where there are catalysts that drive investors to make a trade. One of the early insights I had, let's take an example like a takeover opportunity. So you could be a fundamental analyst and you're looking for companies that are undervalued that you think might be takeover targets. And your hit rate might be super low, but when you get a hit, you're going to have a big win because the stock might double or triple potentially. The problem with that from a quantitative standpoint, in my opinion, is you're relying on the actions of one or two entities or individuals, let's say, to make that work. That being the investor or the company that's going to actually do the acquisition. And when you're dealing with that kind of low number of participants, there's potentially a lot more randomness or uncertainty associated with it. What we want to focus on are situations where a lot of investors are coming to the market to make trades or to make a decision, because we think that increase in the numbers results in some more potential to find statistical significance and biases. If you're dealing just with one individual, you can't predict what kind of biases they're going to have. But if you're dealing with thousands of humans, and if you've ever been to a sporting event at the end of the game, it's going to be hard to get out unless you're right next to the exit row, because people just line up and slowly shuffle out. And that's kind of an analogy to the human behavior that we're looking for when we're looking at these events.
We have an expression here for something that's a negative example of this, but we're lacking an expression that's something for a positive expression of what you're trying to talk about. And Rada, you put your finger on it. We say garbage in, garbage out here, right? And when you're talking about data and machine learning, that's one of the problems that we're trying to avoid. If you take that into the world of AI, one of the problems that people talk about at the moment is kind of this bias in, bias out issue that we've got. If you've got data that represents the biased view of the world, your AI is going to produce biased results. And normally that's a negative. And we don't have really a good way to say, well, you're really looking for biases, right? It's certain biases that you don't want, but other biases that you do. And you're looking for those biases to get something else out.
When we think about machine learning, there's probably 3 core reasons why we take that approach. I mean, the first is it allows us to analyze a lot more. We're a small team. We're two full-time people. It allows us to analyze a lot more information than we'd be able to do on our own. And when we're dealing with news and events, obviously it's a very time-sensitive process. So overnight, there might be 300 companies with significant events. It would be impossible for us to process that information in that time. The second reason is that we use AI. It takes our bias out of the decision-making process. So here we are trying to exploit these or understand these investor biases. We want to make sure that we're not adding our own bias to the equation, and that being systematic and also being AI and machine learning driven allows us to do that. And then third is, I think, the reason that most people think of when they think of AI, which is we think it allows us to find subtle nonlinear relationships between different signals or data points that it would either be very difficult or maybe even nearly impossible for an individual analyst to identify by just going through the data over years and years.
I'm glad that I have an AI expert and machine learning expert here, because when I speak with the managers who are discretionary, they talk to me that the market has changed because there are more and more people using AI. And so now I want to ask you, because you are using it for a long time, I mean, do you think that the market has changed over the last years due to AI?
We obviously have a very hyper-focused on what we do. So it's within our context, I think the high-level answer is no. In general, no. I think there have been changes, but what I like to say is, well, the proof is in the pudding. So if your performance is consistent and has been good, then that should be evidence that the market hasn't changed too much. Now, obviously, we're not, standing pat and not making updates and making improvements, but we haven't been making like groundbreaking changes and brand new improvements that we are seeing like huge changes. So I would say for us, it kind of goes to this idea that you need good data. I think it's actually could be providing an opportunity for us. If there's someone out there that's just getting started, that doesn't have good data, doesn't have a sound process, doesn't have good risk management, and they come into it thinking, hey, I'm a tech expert. I'm an AI expert. I can crack the code of the markets. They could actually be introducing their own biases that we could take advantage of over time as we collect data. So in some sense, it might actually be providing an opportunity for us if a lot of novices or people that have these grandiose ideas that are trying to apply technology to the markets that just they might not understand the intricacies and the difficulties of simple things like when you run a back test, you need to incorporate transaction costs because contrary to popular belief that trading is free, these days trading is not free. You're paying for it some way or another.
The whole model or set of models is, changing gradually as you are improving it, etc., etc. When the people start with the quant trading, they are usually happy that they have the first, second, third, fifth model, etc. But after a while, you realize that you have a lot of the models, a lot of the predictors, and after a time, you need to somehow tidy up. So you need to distinguish between, this is the approach that is still working, and this is the approach that is not longer working, or this is the model that is, probably losing the edge. What is like the threshold when you decide, okay, maybe this is not something that's working, I should remove that, or I should at least think about, do I need to change this strategy, this predictor, or whatever?
I'd say for us, we're always looking for incremental gains. We're always looking for ways that we can tweak or find a new signal. It goes back to, using the scientific method or approach. You have this idea of the world, you build a model that tries to represent how the world is, and the better your model can get at representing the world, hopefully the better at making predictions it will be. So when you start with that baseline, you continue to make improvements, you're trying to make those incremental improvements over time. For us, that's a continuous process. I wouldn't say that there's any particular timeline that we set in stone. We're always looking at how our inputs or signals are performing individually relative to the overall model. We're always thinking about looking at outliers, trying to understand, was there something that occurred in a situation that if we had certain data or certain inputs, it would have allowed us to make better predictions. We do a lot of research, and we actually publish some of our research as well on a quarterly basis on our website.
Yeah.
And we recently did a research piece that looked at the question you asked earlier, are we seeing degradation in signals? And we showed that we have these 3 high-level signals that relate to how we look like fundamental information, technical information, sentiment. Have those themselves degraded over time in recent years because of the enhancements in AI, and also has our model over time. We see the individual signals, they ebb and flow. The overall model continues to perform strongly.
So it's more about, so individual parts or individual predictors, they may have bad time. Overall, when you have a lot of them, you can diversify between them. So at the end, you are not, specifically focused on just one type of the predictors, like price-based, but you must have all of the pieces of the puzzle, and then it's much, much more stable.
And when we retrain the model, if there's a particular input that's fallen out of favor, as we optimize the model, that feature will get less weight and it'll be less important moving forward.
Yeah, and okay, and here is the question. So it's not as popular topic as it was in 2009 when everybody was talking about Black Swan, because we had the Black Swan at the time. 2008. It can repeat, and it repeats always. So there are the things which are not in the data. So, how to deal with the things that are not in the data, how to deal with the black swans, from your perspective. The unknowns, because, when you have a data, you have the known unknowns, but, there are the things that are not in your data. So, what to do with them?
Great question. And I think it's very pertinent now. I think it does come up in terms of, the recent news about meme stocks in the last couple of years, and just that would certainly be something that would catch you off guard if you weren't aware of that.
Exactly.
So for us, it comes down to having sound risk management practices. We typically have holding periods that are 2 to 3 days on average. So that's relatively short, depending on who you talk to. And so we have a short time period. We keep position sizes low relative to the overall assets that we have. So that has some inherent risk management on its own. And we also will exit positions dynamically based on price feedback. So the idea is that we cut the tails off of the distribution. So if you look at your return distribution, you want, maybe a slight positive average and a positive skew on your returns. We cut the tails off, and what that allows us to do is it takes away some of those really nice winners that you wish you would have let ride. But because we do it in a systematic fashion, we're comfortable with the fact that we're also getting rid of those losers on the downside that we wish we would have exited early. And it improves risk-adjusted returns, which is important for us and our investors.
So there's a question kind of bubbling up here from the depths of the last question. I'm trying to figure out how to formulate it. You were talking about the black swans, Rado, right?
Mhm.
And Alex's research. I think where a lot of the genesis of Tocaya came from was the breadth of research into human biases, all the crazy things that we do as people. And we haven't really gotten into it too much, but it sounds like part of what you're doing with the data is trying to discover and reveal the implications or the consequences of those biases, right? So if you take the last black swan event that Rado was talking about, the 2008 financial crisis, if that was caused by an aggregation of predictable human behavior, let's say, is that the kind of thing that's covered in the research and might be you might be able to incorporate into a strategy, or is that just some kind of exogenous event that you just have to put risk controls around? There's no sense trying to systematize that. Where are you there?
It definitely could be if that's your edge, if that's your approach. Looking at macro market moves. For us specifically, we focus on stock-specific idiosyncratic events. So we actually hedge out all the beta exposure that we have in our book at any given time. So we might be long 10 stocks, short 5 stocks. Net long, we'll hedge out the beta exposure so that we're trying to really focus on that excess return or alpha component and really take away any of the market risk, that beta component that's occurring due to swings because of geopolitical events or just employment announcements or whatever it is on the day.
Yeah. So we are basically trying to not to be influenced by the macro, but just to get the breadth out of the idiosyncrasies of individual stocks. And when you make a lot of the bets over time, the math should be on your side in case you have the edge.
Can you give us a quick definition of what you mean by idiosyncratic alpha? Because I don't think everyone's going to have the same idea of what that means.
So, in layman's terms, it means or there's news happening in a stock that's very specific to that stock. For example, a company releases their financial results for the quarter. On that day and the next couple of days, yes, the impact of the market, if there's big macro news, it might influence the stock price a little bit for that stock, but mostly it's that new information, the people that are trading that stock that are actively trading it and trading it with a purpose are going to be the ones that are reacting to that information. So we're looking for situations where we can predict over the short term which way that stock's going to go after people have begun to react to that news.
So if other people are biased in the way they react to those idiosyncratic events, Is that a bad thing or a good thing?
Absolutely a great thing for us. The more bias there is in how traders are reacting to news, the more of a powerful statistical signal we'll be able to pick up, and the better our predictions will be.
Here I have a question. I mean, who do you think are the counterparties? Because I mean, at the end, so it's like a zero-sum game. So I mean, as a hedge fund who is shooting for alpha, you are basically trying to outsmart the other part of the market. And there is always somebody on the other part of the market. So, I mean, who do you think is the other part of the market who is basically biased?
We like these events because they're complex and there are a lot of market participants. You'll have day traders, retail traders that will react to news and information. You'll have long only buy side shops that will huddle up after an earnings call and have a meeting and make a decision. You'll have discretionary traders. You'll have other quantitative hedge funds that are running a cross-sectional systematic book.
Slow moving, etc., etc.
Yeah. And I think one of the other insights I took from my prior experience is that in some cases you have firms that are very large, and it takes them multiple days to either add to a position or remove a position because they're just so big and they don't want to be over a certain percentage of the average daily trading volume in a stock. And they're going to have persistent market impact as they trade, unless they're super lucky and they find a block in the dark that they're able to cross their full size. But it's less common. So I'm a student of the market, and I've seen the statistics. When you look at average trade sizes in, let's say, NYSE and NASDAQ listed stocks since 2000, as the market became more and more electronic, trade sizes came down. Blocks became less prevalent. Brokers introduced algorithms at the trader's fingertips to mask their trades. Okay, we wrote a piece back in my old firm called the VWAP trap. Beware of the VWAP trap. This idea that if you're parceling your order in a very systematic fashion, high frequency traders could identify that and pick you off. So instead, use more stealth-based algos that can, take up a chunk of liquidity and then hide. Big institutional traders, have to parcel out orders over a long period of time so that they aren't found. If they're not able to execute a big block, actually provides an opportunity to smaller, more nimble traders. The high frequency traders, if they're able to pick up on a signal, they can trade off that. In our case, our holding periods are short, as I mentioned, 2 to 3 days. We can enter a position in the morning and exit it later that day, and that would be a profitable trade for us. Whereas another market participant, they might have a holding period of 2 years. So they don't care if it takes them a couple of days to get into a position.
Yeah, so we are basically taking few nickels, or I mean, taking part of, I mean, the large holders who are actually not paying just the commission, but they are paying you because, I mean, yeah, they could probably execute it better, but for them it would mean that they would need to be as nimble as you are, and because of their size, they are not able to be. Now I have a technical question. I know that I'm jumping from the topic to the topic. I like that I have you here. There are a lot of machine learning algorithms. I mean, you mentioned before that in the past there were genetic algorithms. They are not so popular at the moment. So, I mean, there is a lot of discussion. I mean, yeah, what is the best one machine learning model to use? It's like discussion between, yeah, what is the better? It's iPhone or Samsung or Motorola or I don't know, whatever. So I mean, so let's get into this topic a little. So what do you think about all of this discussion? I mean, is there something that you personally like more or less, or do you think that, I mean, ensemble approach, so you mixed more machine learning models together, is better, or what is your stance on that?
Yeah, so for me, my opinion is we use an ensemble approach. So we use different algorithms. There was an interesting paper that was recently published by a few researchers at the University of Chicago, Booth, It might still be in preprint. I'm not sure if it's published in a journal yet. But essentially, what they were trying to do is take a large language model, an LLM, and train it on company financial statement information, not the text, just the tables. And the punchline was that they were able to, if they were able to prompt the LLM intelligently, they were able to make predictions about would the next quarter's earnings be higher or lower than this quarter's earnings. They were able to have it perform better than human analysts on the sell side. That result isn't so interesting to me because we know sell side analysts have a lot of biases, and there's things you can do pretty easily to be better than the sell side analyst. The interesting result they found was that their model did pretty much as well as a state-of-the-art gradient boosting machine that was trained on the same data. It's interesting to me because it doesn't actually provide anything incremental or new if you use this LLM in terms of predictive performance. Maybe you could say it's easier. Someone that didn't have coding experience, that wasn't able to create a gradient boosting machine algorithm and parameterize it and optimize it in the first place, wouldn't have been able to do. But the end result in terms of the state of the art predictive power hasn't improved. So I think it's still going to come down to no matter what algorithms are available, having good data, understanding how to prevent biases that cause incorrect results, like look ahead bias, things like that. And then also just a lot of incremental work, a lot of effort in understanding how to model whatever it is that you're trying to model, and making sure that you've got like a sound process and to iterate and improve that. So to answer your question, long and short, yeah, we use an ensemble approach. I think we use open source models. We fine tune them on our end, but I don't think that there's like one state of the art model that's like the panacea for everything.
Yeah, exactly. Holy grail of machine learning at the moment.
Yeah. I mean, maybe in other fields and other disciplines, I think that, yeah, there's really cool stuff going on in other spaces, but a hit rate of 51, 52% for us, depending on your time horizon, is really good. I mean, you can make a good strategy doing that, but in other disciplines, yeah, you would be out of the job. Like you're trying to get 99% accuracy when you're trying to classify, okay, was that a cone in the road or a person in the road for my self-driving car algorithm? Yeah, I mean, you want 100%, honestly, but the finance hit rate wouldn't cut it there. So, it's different applications, different real world situations. So that's something to be aware of.
Yeah, I understand. I mean, you partly answered my next question, and that was, I mean, how do you think it will develop in the future? Machine learning and the market and stuff like that. I know it's about the prediction, and it's very hard to make the prediction, especially about the future. But I mean, how it will develop? So what is the path? I mean, better models, more data. I mean, better insight, or I mean, ensemble of all of that.
Yeah, I'll take a slightly different angle on that. I'll say, I made a prediction 10 years or so ago, privately to my friends and colleagues, and I said, I think software businesses as a whole are going to be much less relevant in the future. And I had a friend of mine that says, no, man, these businesses are great. They're going to continue to perform well. I said, the gap between machines and humans in terms of interaction is going to drastically narrow. If you think about it today, like we have two main mechanisms that we interact with computers. We have keyboards and a mouse and touch, to some extent. If we want computers and machines to do things, we have to interact with them through those mechanisms. And beyond that, we actually have to understand their language. There's computer programming language, there's Python, Java, SQL. We have to be trained to understand how to make the machines do what we want to do. My prediction and what we're starting to see now is machines are coming into our realm of natural language, and therefore being able to have the machines help us as a tool is becoming much more accessible to the average person that isn't trained in computer science or programming. And so I mentioned this to your as an answer to your question, because I think our ability to rapidly go from an idea to an implementation is going to narrow. An average person's ability to have a machine create a solution for them is going to narrow. That's why I said, software businesses, machines are already writing code. There's co-pilots and integrated into IDEs. Yeah, there's still some kinks to work out, but fast forward 5 years from now, it's going to be less important to know how to write code. It's going to be more important to understand the logic and the design and those sorts of things. The more higher level
Why?
thinking, exactly, the why.
Why to write the code?
So, I think that'll apply in finance, because I think you have a lot. This term quantamental has been thrown around for a while. This idea of the convergence of quant investing and fundamental investing, that's going to, I think, continue to become more popular and rise, because the folks that were traditionally fundamental, it's going to happen, I think, without, people might not even notice that it's happening. They're going to be like, you have fundamental people that are using LLMs already. You can call them quantamental. I mean, they're incorporating that machine-based algorithm or decision making into their process just by doing that. So I think that's how it'll change.
Yeah, so I mean, here's the question. I mean, so for somebody who would like to improve in the trading, I mean, what should he focus on? So I mean, from this, what you said, it's more about like the fundamental idea and understanding of the market. So it's more important to ask correct why questions than to actually get proficient with coding. Or yeah, you must be proficient with the coding. But I mean, what will get you better edge is to actually try to understand the process of why the prices move, etc., than just learning new software thing.
Yeah, absolutely. I think so. Yeah, and always having accurate, timely data. That's always going to be key.
Yeah, you are right. I mean, you are right. You're right with it.
So I was thinking the other day was thinking about natural language processing you were talking about, right? And I was wondering, is it science fiction? Is NLP science fiction? And as a technical guy myself, I'm tempted to say no, but listening to you, Alex, it's kind of like your sci-fi vision of the future is really what your software company bet is all about, right? What's going to kill software companies? Is it really AI, or is it this kind of like Star Trek vision of the universe where you can just shout the command at a computer and it'll do it? You kind of blend Captain Picard with your average prompt engineer these days, and you say, computer, write me a program that'll trade stocks, right? You don't have to know how to write the code, but somewhere somebody's producing the thing that blends those two things: how to interpret the person's instruction, how to generate that code, and I guess use the good data to produce an output.
Being able to speak more precisely, understand exactly how to prompt the computer to build your solution is going to be more and more important. I think there are already people talking about how the next wave of jobs in our economy, people are worried obviously about a lot of jobs being lost due to machine learning and automation and AI. So the next wave of jobs will be people that are prompt engineers. It's going to be a new profession that didn't exist before. But I think it's true. I mean, and if you think about it, any tool that's been transformative in our society over time, it's definitely destroyed jobs, but then it creates new jobs. And my personal opinion is that it'll be the same in this case, and maybe we'll start to get some more benefits to as a society, that maybe if we have to work less but can produce the same output, that's good overall for people's mental health, for their family lives. It should be looked as a positive development, I think.
So understand markets precisely, understand, I mean, the fundamentals, why the price is moving. And I mean, that's like more important than, and data, of course, because you must base the understanding on the data, and you must have a good data. I mean, is much more important than the actual, I mean, technicalities. Let's go with that. Then, if you have any other questions.
I actually have a question for you, Rado. And then based on what you said, I'd love to get Alex's reaction to this. I'm thinking back to kind of the beginning of the conversation. So we were talking about human bias, right? So Rado, you're kind of the king of academic research. What does the academic research say about human biases and the effect of its presence in the markets? And part B of that question is, what on earth does that have to do with quantitative strategies?
So, I mean, basically, what does academic research say is that, yeah, we are all biased. So we are not calculating machines. We are humans. So it means we have emotions, we have the greed, we have the fear. And when we make a decision, we do not make a decision based on all of the data that were in the past. So we are, I mean, doing the simplifying calculations, and we are trading very often based on emotions. And I mean, those emotions, they impact the prices, and you can pick up the nickels when you do not have those emotions, and you just do the statistic and you do the calculation. Which is, I mean, Alex doing, and he's doing the machine learning. I mean, what is academic research showing us is that over the time, the smart participants who starts to do what Alex is doing, so they start to pick those nickels, they close the loop. So it means that the smart participants, they will start to impact the prices. And over time, I mean, the anomalies that are like the most obvious, they are losing the edge. But I mean, what I think, and this is just my opinion, but maybe some of the research is showing it's true, is that they lose the edge until some point. Because after that point, I mean, for the smart participants, it starts to not be interesting to longer follow this anomaly or this bias, because I mean, it's like there are other lower hanging fruits. So even the smart participants are moving like the crowd. So they are moving over the market, they are picking anomalies. And so from time to time, I mean, there are anomalies that offer the higher spread, and they are picked up. And by me picking up those anomalies, other anomalies appear. And those anomalies that are picked up, I mean, their Sharpe ratio goes down. And there's like ebb and flow and then flow. So that's like what happens to the anomalies that are long in the market, and people know them, like small, like size, value, and I mean all of the old one, momentum and stuff like that. So they have their time in the market for a lot of years, and then they are, I mean, nobody would like to be the CTA in 2015, 16, 17, 18, 19. Nobody would like to be the momentum trader in the futures, because I mean, you could not get any money out of it for 5, 6, 7 years. And then we had, like, once again inflation, once again we had strong trends in commodities, and 2020, 21, 22, 23, it was the great time to be the trend follower in the futures. And it happens to a lot of the anomalies. So that's like my answer to that.
Yeah, I think that's a future episode all on its own. So some of these strategies work when they do, they work when they work, and they don't when they don't. And that's just kind of a fact of investing life. So we could do a whole episode on that. But Alex, what'd you think about, Rado's kind of summary of the body of academic research on bias, and where does that fit with quant?
I really like it. I think he summarized it very well. I would like to provide one probably imperfect analogy, going back to the idea of thinking of the markets as like a game of poker, for example, a game where if you have a slight edge and you have skill over time, you can have an advantage and continue to profit and make money. Imagine, you've got a poker table and you've got a couple of the players that are very skilled, and over time they're making money, but they're making moves because they know each other are very good, and so they're changing their betting strategies and their bluffing strategies, and maybe that's similar in some way to this kind of ebb and flow that Rado's mentioning. At the same time, you've got new players coming to the table that get bankrupt, and then new players coming in, and they're going to behave differently and have different biases. So the good skilled players that remain at the table are continuing to change, to adjust to these new players and kind of their different biases, and maybe in some way that's related to the different strategies and kind of the ebb and flow that we see in the markets.
Okay, I got you. So,
I like it a lot. I mean, in
Okay.
your no, your example about the poker table is great. I mean, and you nailed it, I think, because that's really true. That's
yeah, it is a good analogy. I'm trying to draw a quant distinction here for the budding quants that are out there, because I don't think everybody kind of gets the difference. Like if I'm a fundamental discretionary trader, but my strategy is all about playing off of other people's known biases, right? I'm making some really big bets at the poker table. I'm swinging for the fences. I'm trying to win $100, after an hour of, trying to read somebody's face or something. Whereas what you're saying is, if you're a quant, but you're also playing off existing biases in the market, that's what the picking up nickels is about, right? It's about all the little trades, exploiting these anomalies. Sometimes you're going to be right. Sometimes you're going to be wrong, especially when some players leave the table and others come in, as you were talking about, right? It takes time to adjust to that. But if you're systematic about it, you don't have to be right all the time, but over time, those nickels are going to add up to the dollars.
Yes, you nailed it perfectly. I would say that's why the analogy is somewhat imperfect, because even if you're a very skilled poker player and you're playing in a very systematic fashion, eventually you're going to have to go all in. Let's say if it's a tournament and you're playing, to win the entire pot. A quant in finance would never go all in, right? So that's why the analogy kind of gets stretched there, and it kind of loses its intent. So the skilled player can be a quant investor. The skilled player can be a discretionary investor. They're discretionary investors that have really good skill at picking stocks and have been at it for a long time and will continue to, because they have a good process, because they've found an edge. So the analogy does kind of fall apart a little bit there, but hopefully it makes a point.
One last one, just to take us out. I'm thinking of the time of year when people are going to be watching you explaining these things. And without getting into the politics, is the news around an election an event?
It most certainly is. And there are a lot more people that are a lot smarter and focused on it than I am. For us, we want to hedge it all out if at all possible, and really, keep the book as desensitized to that as possible. But yes, it most certainly is an event, and it might impact the markets a lot. It might be a dud in terms of how it impacts the markets. I don't have a prediction on that. That's something that's well outside of my wheelhouse.
Yeah, well, sometimes no news is good news, right? Very
Indeed.
good. Okay, well, thanks, Rado. Thanks, Alex. It's great for today. So now for all of you, if any of you want to meet Alex, or to meet Rado from Quantpedia, or to join us as a guest, or if you're interested to otherwise support the channel, contact me, Dan Hubscher. These details, here they are. And just note that any questions regarding any investment offerings will be deferred to an email follow-up for compliance purposes, as these videos are not intended to be about investment offerings. But if you like this video, please do come back for our next interview with a quant manager guest. You might also want to watch the other videos on the channel, so don't forget to like, comment, and subscribe to the Quantbeats YouTube channel. Finally, you can visit us on our websites and YouTube channels for more. Here they are. Thanks for joining, and as always, have a quant day.
Thanks, Dan.
Thanks.
Thanks, Rado.